delve into the case study is to discuss a little bit about the background of the company. DSME was founded in 1973. They hold over 35,000 direct and indirect employees, and they are estimated at being able to produce around 70 units per year. They have a very varied product line. They produce everything from LNG vessels to passenger ships, carriers, container ships. In the company's history, they have overcome several challenges. They've overcome everything from labor strikes and uprisings to the most recent 2008 global recession. And they have managed to perform so well due to a corporate culture that has been focused on trust and passion. The biggest challenge right now that DSME is facing is its ability to remain competitive. The challenge specifically is that there are a lot of new entries into the industry, and it's a very highly technical market, but customers are looking for a lower cost, and that can be a real challenge for them to produce. The company's current situation is that they have 151 ships on backlog, and they have gained 14 in 2014 orders. They do hold a fairly firm market presence in the high-end industry, and they have begun to expand globally. Right now, they're located in Romania, China, and even the United States, just for some examples. They have begun to diversify into different industries, and right now, the financial industry has a great interest in energy solutions, which is a great thing for the company because they have a very strong reputation for being able to find solutions to those problems. A short overview of the SWOT analysis. The competition right now is offering a lower cost solution for a more standardized product, which could be a threat to their success. However, DSME has a very good ability to adapt to its customers' needs. The industry is, of course, cyclical in nature, but it is seeking energy answers, which could be a great opportunity for DSME in the future. There has been a somewhat downturn in European demand. However, the economy does seem to be looking up, and there is a lot of positive growth and opportunity for success in the future. And they are a very efficient, technologically advanced company that offers a really great value-added product. However, they do have a high cost of operation, and they carry an older workforce, which could be weaknesses for them in the future.
Hi, this is Christian, and I'll be looking at the next section of the case study. So DSME management was looking at diversifying into shipyard construction to eliminate the financial risk associated with the cyclical nature of the shipbuilding industry. We also looked at the option of continuing on their same path, and then we took into account other options. We narrowed that down to two financially viable options, diversifying into shipyard construction and diversifying into energy products like LNG and wind energy. So option one was diversification into shipyard construction. Again, this would diversify their revenue sources and spread out the financial risk of the industry. But some of the downsides of shipyard construction, it's dependent on new vessel construction. Shipyards are impacted by the 2008 global recession. And things like the Baltic Dry Index, which is a look at global freight rates, and it's a good indicator of global economic growth. That's been slow to recover, and in the last few years there's been shipper and carrier excess capacity on a lot of vessels, which has slowed the contracts for new vessels. This is a look at the year-to-date Baltic Dry Index. You can see it's dropped off steadily. Historically, it's low in the spring before the peak season in the late summer, but since 2008, it's dropped off quite a bit. Again, you can see on the chart here, it shows since late September 2009, the Baltic Dry Index has dropped off quite a bit. So we thought diversification into shipyard construction was financially risky. European banks have been hesitant to finance new ship construction, and shipyards globally are losing orders In China, between 2012 and 2013, there was a 23% drop in new ship construction orders, and again, the BDI hasn't been doing very well either. This is again is a comparison of global growth, the global GDP compared to new ship orders, and you can see they're really closely related. So when the economy is not doing well, new ship orders drop off quite a bit, which means the need for new shipyard construction also drops off. Option 2 is diversification into energy products, things like LNG, wind, and hydro, through global joint ventures, which would also help spread the financial risk and get a foothold into foreign markets. DSME has a history of successful joint ventures in places like Romania and Russia. This allows for strong foreign currency and foreign investments. Right now, LNG and energy financing is favorable in places like Southeast Asia, where there's a lot of energy construction going on. There's some positive trends in the U.S. for LNG exports in the near future. And globally, wind energy has been growing. You can see the chart to the right shows megawatts produced per year globally, and the offshore market's growing pretty quickly compared to the onshore investments. Option 2 continued is the sustainable demand for offshore LNG. You can see the chart at the bottom shows that the percentage of oil produced offshore since 2000 and forecasted for 2020 is fairly reliable. The increased fuel prices lead to increased projects where companies are trying to find new sources of energy, and development in new areas like Africa and Southeast Asia requires investments in new equipment and vessels that the SME can capitalize on. I'm going to hand it over to Sam for the recommendations.
We have 4 basic recommendations. The first is that the company not over-diversify. The second is that they should focus on expanding globally, often through forming joint partnerships. They've had success in the past there, and they should continue to focus on a high-end, value-added market. We believe that the company should not over-diversify, and they should focus on LNG and wind energy instead of the construction industry, because there is a sustained positive growth in the energy market, whereas the construction industry will require a large amount of capital and does not offset the cyclical nature of the industry. That basically means that as the number of new orders drop, the demand for shipyard construction will also drop, and that will lead to an added risk without much reward. There has also been some concern about the stockholders in the company right now, and it can be extremely risky to enter too many new branches of business when there is a chance of an ownership change. We do believe, however, that the company should continue to expand globally. That will allow them to grow while mitigating the cost of expanding their infrastructure. It does allow them to focus on gaining customers around the world. By offering branch locations closer to the customer, it will increase the transparency of the company and also allow for delivery of the final product to be much simpler. It also provides them an opportunity to gain a workforce that can often be efficient and highly trained at a lower cost, and that will help them to offset their older, more expensive staff that they have right now. The easiest way for them to continue to expand globally is to form joint partnerships. It does allow them to enter markets that might have a more strict governmental regulation. It offers a lower cost of startup, and it will increase the operating income percentages, allow for better customer service, and hopefully provide an increase in new orders. They've had success in the past working with both Russian companies and the Romanian government that has allowed for them to enter entirely new markets, which has been great for them in the past. We do believe that they should continue to focus on the value-added market because they have a great reputation and proven experience with that market, and they can feature the ability to customize their products to counter the less expensive competitive option, which is often too standardized to meet the customer's needs. Their core competency is to provide exactly what the consumer needs, and so they should highlight that in any marketing.
Just quickly to look at the measures of success, this will determine how DSME determines if their decision was successful or not moving forward with diversification into energy products globally. Of course, you want the company to make financially solvent decisions, so we looked at an increase in operating income. You can see even in 2008 that it was a little bit higher than it is now, and of course in 2011 it kind of reached its peak before it dropped off in 2013. Some of that's due to a subsidiary problem that they had in dealing with foreign currency, but again, we would like to see an increase in operating income as a measure of success. So we kind of looked at a 7% increase in operating income year over year. We thought that was a reasonable increase to deal with profit sharing with their companies that they do the joint ventures with. That helps maintain financial solvency, and it would help them come up with cash to kind of make advance payments, and that would help out their credit rating. You can see since 2003 their credit rating has been improving, and by 2026 they should be able to regain their 2011 levels, and that's of course just looking at the 7% increase from the new ventures in energy markets. And that's it for the presentation, and I'll show the works cited really quickly. All right, and thanks for your time.